Hi, my name is Trevor Drinville, and today I'll be sharing my senior thesis project with you titled Comparing Retirement Investing with Fixed and Lifecycle Funds Using a Variety of Asset Classes. My director for this project was Dr. Kelly Klein, and my readers were Dr. Peter Larson and Dr. Theodore Wendt. What is the best way to invest for retirement? This is a pretty tricky question with all the different options that are available for investors. One of these options is what should you invest in? This could be stocks, bonds, cash, commodities, real estate, high yield bonds, and this list can go on and on. There's also many different strategies that are available for investors. This includes lifecycle funds, fixed funds, and once again, this list can go on and on. In this study, we will compare 29 different retirement portfolios, which all contain a different mixture of stocks, bonds, cash, commodities, real estate investment trusts, and high-yield bonds. In some of these 29 portfolios, the amount that is invested in each asset will change over time. The portfolios are evaluated using a computer simulation that is based on historical data that is ran numerous times over a 40-year period. Now we will hop into the sources that are used for the historical data of each asset. Starting off with stocks, which if you don't know, are an investment class that represents the ownership of a portion of a company. Now, in order to represent stocks in this study, we use data from Standard & Poor's 500, more commonly known as the S&P 500, which ranged from 1980 to 2020. From this data, we found the yearly rate of return, which, as you can see from the histogram, is not normally distributed and it has a left skew. But in this study, we make the simplifying assumption that it is normally distributed. After this, we found the mean of this data, which was 10.08%, and the standard deviation, which is 15.65%. Now we will move on to bonds, which are an investment class that is a portion of a corporation's or government's debt that is securitized as a tradable asset. To represent bonds in our study, we used data from Bloomberg Barclays U.S. Aggregate Bond Index, which ranged from 1980 to 2018. As you can see in the histogram of the yearly rate of return, this data is also not normally distributed and it has a right skew, but we'll once again be making the simplifying assumption that it is normally distributed. The mean from this data is 7.67%, and the standard deviation is 6.88%. Now we'll move on to cash, which is a short-term investment class that provides return through interest payments. It is very low risk, but it also provides very low return. To represent cash in our study, we use data from a certificate of deposit, also known as a CD, ranging from 2001 to 2018. As you can see in the histogram of the yearly rate of return, this data is also not normally distributed, but we will make the simplifying assumption once again that it is. From this data, we found that the mean is 1.4% and the standard deviation is 1.69%. We will now move on to commodities, which are an investment class that represent raw materials such as food, gold, natural gas, and that list goes on and on. To represent commodities in our study, we used data from the S&P Goldman Sachs Commodity Index, also known as the S&P GSCI, which ranged from 1993 to 2020. As you can see in the histogram from our yearly return, this data is also not normally distributed, but we once again are going to make the simplifying assumption that it is. The mean that we found from this data is 6.92%, and the standard deviation is 26.75%. Now we move on to real estate investment trusts, also known as REITs. REITs are an investment class where investors combine their capital to buy a share of commercial real estate and then earn income from their shares. To represent REITs in this study, we use data from the FTSE US Real Estate Index ranging from 1971 to 2020. As you can see from the histogram of the yearly return, this data is also not normally distributed, but we're once again making the assumption that it is. The mean that we found from this data is 3.45%, and the standard deviation is 18.74%. The last asset class used in this study was high-yield bonds, which are a type of bond that pay higher interest rates than normal bonds because they are more likely to default. To represent high-yield bonds in this study, we used data from 3 different funds. The reason we used data from 3 different funds is because we could not find a single fund that had this large of a time period. From these 3 funds, we found the yearly rate of return, and you can see them plotted in the histogram. From this histogram, we can see that the yearly rate of returns are not normally distributed, but we once again are going to make the simplifying assumption for the study that they are normally distributed. From this data, we found the mean, which is 10.19%, and the standard deviation, which is 14.31%. Now we will look at the 29 different portfolios that were used in this study. The first set of portfolios was 6 portfolios that are fixed 100% on one asset. An example of this would be 100% high-yield bonds for all 40 years. The second set of portfolios that we used was 5 portfolios that contained a fixed mixture of stocks, bonds, and cash. An example of this would be 80% stocks, 20% bonds, and 20% cash for all 40 years. The third set of portfolios that we used was 5 portfolios that contained a fixed mixture of stocks, commodities, real estate investment trusts, and high-yield bonds. An example of this would be 40% in stocks, 20% in commodities, 20% in real estate investment trusts, and 20% in high-yield bonds for all 40 years. The final 2 sets of portfolios that we used were life cycle portfolios, which means that the percentage in each asset class will change as the years go on. So the first set was life cycles, which contained a mixture of stocks and traditional assets, and the second set was 7 of them that contained a mixture of stocks and non-traditional assets. Now we will talk about our hypothetical investor. We assume that this investor begins investing 40 years before retirement, so say ages 25 to 65. The wage for a hypothetical investor will be the average wage by age group that was found by Klingman and Burkhalter. This wage can be seen in the graph on this slide. We will also assume that our hypothetical investor will contribute 10% of their yearly salary to investments, which is the minimum amount that is recommended by financial advisors. To create a simulation for the hypothetical investor, Python was used. The first step in this process was calculating how much the hypothetical investor invested by taking 10% of that year's income. After this was imported into the notebook, the first year was multiplied by random rates of return selected from the normal distribution of that particular asset. This number represents how much return was made on the investment that year. This number was then added back onto the total invested, which gives the total account value at that time. This process was repeated over 40 years and was done 100,000 times. The reason we did this 100,000 times is because it shows a distribution of likely outcomes. The figure shown shows the first 10 simulations from the 100,000 simulations we did for the 100% stock portfolio. As you can see, all 10 are different, which shows us that our simulation truly is random and we're getting different results each time. To measure risk in this study, we take the standard deviation of the final year from all 100,000 simulations. As we know, the standard deviation measures the average amount of variability in our data set, and it tells us on average how far each year is from the mean ending value. This means that in the case of our study, if the portfolio has a higher standard deviation, it is riskier because it is then more likely to end up farther away from the mean return. The first comparison we did was a broad comparison of all the portfolios used in this study. From the graph shown, we can see that the 100% stock, 100% high yield bond, and the high yield bond life cycle are all very close to having the highest mean ending value. This means that among all of the portfolios used, one of these 3 will provide the investor with the highest mean return. From this graph, we can also see that it looks like most non-traditional versions of the portfolios produce a higher mean return than the traditional versions of the portfolios. Although this graph tells us quite a bit, it doesn't tell us anything about the risk of each portfolio or exactly how much each portfolio beats the other portfolio. So we're going to compare these closer in the next few slides. We will now compare the 5 fixed portfolios which contain traditional assets, and the 5 fixed portfolios which contain non-traditional assets. From this graph, we can see that most fixed portfolios which contain non-traditional assets have a higher mean rate of return than those with traditional assets. Table 1 shows the mean and standard deviation of the fixed portfolios used in this study. The portfolio code shown in the leftmost column is used so we do not have to write out the full description of the portfolio. ADS means that we have 80% in stocks, 10% in bonds, and 10% in cash. And TAES means that we have 80% stocks and 20% split evenly between non-traditional assets. This pattern follows with all the codes down. From Table 1, we can see that the mean ending value is greater for the non-traditional portfolios than the traditional portfolios. But the standard deviation is also higher, which means that the non-traditional portfolios are riskier than the traditional portfolios. In Table 2, we can see what percentage of the time that the traditional portfolio will produce a higher mean ending value than the non-traditional portfolio. From this, we can see that as we decrease the allocation of stocks, the non-traditional portfolios will produce a greater return than the traditional more and more. The figure shown here shows a comparison of all the lifecycle portfolios that were used in this study. From this graph, we can see that it is more common for the non-traditional lifecycle portfolios to produce a higher mean return than the traditional lifecycle portfolios, but there is a traditional lifecycle that outdoes the non-traditional counterparts. You can also see that the high-yield bond lifecycle will produce a much higher mean return than all of the other lifecycle portfolios that we used. Table 3 shows the mean ending values and the standard deviation for all the lifecycle portfolios used in this study. Note that if the portfolio code has an NT before it, that lifecycle contains non-traditional assets, which are commodities, real estate investment trusts, and high-yield bonds. From this table, we can see that on average, the mean ending value for the non-traditional lifecycle portfolios is higher than the traditional lifecycle portfolios. The exception is Lifecycle 2, which has a higher return than non-traditional Lifecycle 2. This is because Lifecycle 2 does not contain any cash. So this tells us that since cash has such a low return, it could be the downfall to all of our traditional life cycles we see here. Also, looking at the standard deviation of all of these portfolios, we can see that the non-traditional has a higher standard deviation than the traditional, which means that it is riskier. This is, of course, other than LC2, which has a higher standard deviation than NTLC2. Table 4 shows us what percentage of the time the traditional life cycle portfolios will have a higher mean return than the non-traditional life cycle portfolios. This table shows us that the non-traditional life cycles that are greater are only by a little bit. And the portfolios that had the highest mean return in this study were the 100% stock portfolio, 100% high-yield bond portfolio, and the high-yield bond life cycle portfolio. Table 5 shows us that all of these portfolios have a mean ending value that is indistinguishable from one another. So the most interesting part from Table 5 that we can see is the risk or the standard deviation of these portfolios. We can see that the standard deviation of the high-yield bond life cycle is much lower than the other two. This is very cool to see since we often see return and risk go hand in hand, but this high-yield bond life cycle breaks that norm. In conclusion, from the study, we can see that the use of non-traditional assets can help produce a higher mean return to your portfolio, but they do often carry more risk. So for an investor who is not afraid of risk, they can be useful. We also found that in a portfolio containing stocks, cash, and bonds, cash is a major drawback. This is due to its low return. We also found that high-yield bonds can be used to provide higher return and less risk. In our study, the high-yield bond life cycle cut the risk of the all-stock portfolio while providing the same return, which is truly phenomenal. Thank you for listening.